You may not have noticed it, but every week, month and year, like an ice sculpture melting, the buying power of your earnings is reducing over time. That can be easy just to dismiss as not important. However, like the passage of time, it's unavoidable. Policymakers spend most of their time trying to keep control of it. Not enough and the economy stalls. There can be a disincentive to spend and it can lead to stagnant growth. Too much and it can lead to devastating asset price crashes, the destruction of savings and sometimes even civil unrest. This is managing inflation. Hi there, my name's George Agan and I'm Chartered Financial Planner. So what is inflation? Well, inflation is simply the increase in the price of goods and services over time. If unmanaged, it can cause a reduction of buying power of your money. It's something that's so easy to think about with hindsight, but really difficult to see on a week, month, or even sometimes yearly basis. But it affects not only your ability to save, retire, when you can retire, and what you leave to your family. So let's go over how inflation is measured. In the UK, there are two main methods of measuring inflation: Consumer Price Index, CPI, and the slightly older Retail Price Index, RPI. Simply put, each year a basket of goods is measured, which changes with consumer habits. An average is taken, and that's the measure of inflation for that year. CPI is the official measure of inflation used by the Bank of England. So, what's the difference? Well, both RPI and CPI measure inflation, and both of them do it by taking a basket of goods, so that's things like food, clothes, petrol, looking at what they cost last year and looking at what they cost now and finding the proportional difference. But CPI leaves the cost of home out of your basket, so rising things like mortgage payments, rents, council tax, which you pay for in real life, don't get reflected in that. The RPI does take account of those costs and is typically higher due to this. There's also a mathematical difference as well. RPI calculates a proportional difference using the arithmetic mean, and CPI uses the geometric mean. And if you understand that, you're boring like me, and let's be friends, because clearly none of us have any friends. So does this matter? Well, yes. It's easy to be complacent about it. As the last 12 years, we've seen relatively low inflation levels compared to historic standards, so you can't really assume it's going to be that going forward. For example, in the 1970s, there was a devastating period where stalling economic growth was met by high inflation. When inflation's managed really badly, we see things throughout history such as the Weimar Republic or recently in Venezuela. It can lead to hyperinflation. This is where we see wheelbarrows of cash parked outside in exchange for a loaf of bread. Let's face it would be terrible if we couldn't figure out how much our money's going to be worth to do things like buy a house in 6 months, a year, whatever it may be. So understandably, governments around the world take this really seriously, and it's one of their core objectives to keep stable prices. The target set for the Bank of England for inflation is 2%. This is such an important point that the Governor of the Bank of England has to write a letter to the Chancellor if they miss their target either side by 1 percentage point, which is interesting, but bizarre when you think about it. Can you imagine if our politicians had to write to us every time they broke a promise? It's here again. Another thing to be aware of is the nature of inflation in this current environment. Let's go back to that basket of goods position. Well, it's measured as an average, and any mathematician can tell you averages can often paint an unrealistic picture. It's important to understand what the basket of goods doesn't contain. It doesn't contain assets, and this is important because asset price inflation can affect this, and that's the increase of assets over time. As part of handling the previous financial crisis of 2008-2009, central banks around the world underwent a policy of quantitative easing and dropped their interest rates close to zero. This is called monetary policy. The quantitative easing part is often called money printing, which is inaccurate if I'm being honest, because it's an asset swap between central banks and banking institutions. The idea is it pushes liquidity into the system at times of stress. This provides liquidity that banks need and the confidence to start lending again, and therefore improving the prospects of the economy. As if banks apparently feel confident they can lend again, this, as well as signalling theory and lower interest rates, means that they should promote business growth. The problem is that liquidity can drive demand into financial assets and make it more attractive for companies to buy back their own stock, which pushes their price up. So while your consumer prices haven't changed as they are part of the measurement, the ability to purchase some of your assets has become an ever more distant possibility. And if you had those assets originally, you did very well, which over time has stretched the wealth gap and lowered future return expectations of assets. This very accommodative monetary policy that we've been dealing with does have some side effects, which we'll all feel and will continue to feel going forward. But don't just listen to me, take the European Central Bank's view. Concerns remain that the increase in assets and house prices is excessive and results in exceptional exceptionally long periods of extremely accommodative monetary policy. Now, deflation is the reduction of price in goods and services over time, and this has problems as well. It can cause a disincentive to spend, so something that also they need to try and catch on the other side. And there's quite a lot of theories saying quantitative easing may even be disinflationary, as well as the fact that technology often drives disinflation as well. So that's going to be an interesting theme going forward to see if it has an impact on things. So what can you do about it? Well, let's have a look at investing to beat inflation. We all know that inflation is real. It makes a huge difference to the purchasing power of savings over time. And this is a key reason why it can be often worth considering investing if you want to build wealth over time. Now, with any investment, there's a level of risk taken. That's why over long periods of time you get above inflation return. Risk and return are directly linked. Well, historically, investing has been a great way to protect and grow your wealth above inflation. Is that different assets react slightly different to inflation. The market prices in expected changes to inflation, so any changes in the expectation to inflation can have quite a severe knock-on impact. So let's go through a brief view of the main asset classes. So bonds. So a bond is a loan to a corporation or a government in exchange for a fixed level of interest, what's called a coupon. You can get inflation-linked bonds. So for example, an inflation-linked government bond, sometimes in your own currency. That's actually considered one of the best ways to protect against inflation, but the returns you might get are very low. This is the coupon, and also the capital return that you get is linked to inflation. So generally speaking, as far as a hedge or protection against inflation, that is considered one of the more effective measures. So let's just stick to a non-inflationary linked bond. Let's imagine you received a 3% level of interest on the coupon. How valuable do you think that bond would be if you expect inflation to be 1%? So you're getting 2% return above inflation. All right, how about inflation's now 5%? So now you're losing in real terms 2% per year compared to inflation. Well, that's generally how it works with bond prices. If you have a fixed level of interest, the purchasing power of the value of its future cash flows is the important thing. So the money you're getting back for holding this bond is going to be eroded by inflation, and you can imagine you're going to pay less for it because of it. That's why the market can see big swings off the back of changes to interest rates or inflation. That's generally why bonds perform very well in an environment of reducing inflation and not very well when inflation is rising. So equity. Equity is just another name for shares in companies. And when it's done right, in my view, it's holding a diversified group of the best companies in the world, which you can do relatively easily and cheaply. Over time, using history as our guide, equity has provided a very good protection against inflation to a point. As you can see, about 2 to 3% rate is where the growth of equity, the shares, are the strongest. Now you can kind of see where that 2% target comes from the Bank of England. It's not a coincidence, and not all equities are the same. Typically, growth equities have been known to perform well in lower inflation environments and value in higher inflation environments. Now, when inflation is very high, that's also known to be actually quite bad for equity. So it's not full protection using history as a guide. So cash. Cash and inflation didn't used to be clear-cut. In the days of higher interest rates, had a better chance of beating inflation. As you can see here, the base rate, which is the general interest rate for banks, since the global financial crisis has been very low. And the best rates you can get with your cash savings has gone all the way down with it. As you can see, apart from a brief period, cash would have lost you money in real terms since. And there's no indication it's going to change anytime soon. So, alternatives. So the category alternatives is really broad and can cover fine wine, art and commodities. But I'm going to focus on what's often in the spotlight when considering inflation, and that's gold. If you like any information in this video, then I'd suggest signing up for my mailing list, which I'll put a link to. Just one email a week on articles on investment topics, personal finance, and no spam ever. This week's article is a deep dive into gold and the reasons given for using it in a portfolio. So gold is an inflation hedge technically, looking at the data. Gold over exceptionally long periods of time has been shown to hold its value, and there is data to back that up. For example, in the paper The Gold Dilemma, it was noted that the era of Emperor Augustus, a Roman leader, was about the same in inflation adjusted terms in pay as far as a private in the US Army today. That's quite interesting, but also slightly less impressive when you remember that gold effectively was money for a large period of that. Also, talk about a pay rise. However, when we put it into a more relevant perspective, such as a human lifespan, it starts to get a little bit more shaky, where there can be periods of severe over and underperformance above inflation. So if it's to use to be an inflation hedge, you might be disappointed. So property. So we all know that property has been a great hedge against inflation and always will be. Well, similar to the answer on equities, the most accurate response is yes and no. The data's mixed, with periods of strong performance above and also where property drops severely compared to inflation. Since the 1975, there's been a 126% real increase in house prices, so adjusted for inflation. So over the long run, it did clearly outperform inflation. However, to quote the IPF's paper titled Property Inflation, it states, "The observation of positive long-run real returns is not, however, sufficient evidence to be able to say that property investment acts as a hedge against inflation. As the literature shows, if property acts as a hedge against inflation, we would expect that the nominal total returns, all things being equal, would move broadly in line with inflation, and that real returns would be invariant to inflation in the long run." Basically, the fact that property has done better than inflation in the long run does not mean property's growth is linked to inflation. This graph also illustrates this, where there's periods of dips in returns adjusted for inflation. So what does this mean? Well, it's sort of the past performance is not a guide to future returns argument. You may hold property in the expectation to beat inflation, which is possible, but it is also possible that high inflation can be met with house price crashes. In fact, that's very plausible if it happened. So whether you like it or not, inflation or deflation is here to stay. So maybe inflation isn't all that bad, only a few percentage points a year. Well, the problem is inflation, like growth, compounds over time. So even modest inflation over time can have a big impact. So let's go through a few examples, and let's say we had £1 at these dates through some events of historical significance. And let's see what that would be worth today in real terms if it was just left in cash with no interest applied. So just to see the compounding impact of inflation over time if the money was just left under a mattress. So this is compared to 2019, as we don't have the full data to 2020 yet, and I've rounded the figures to the pence just to make it easier. So the year of the Brexit vote was 2016, and that pound would be worth 90p. The year of the London Olympics in 2012, that pound would be worth today 84p. The financial crisis in 2008, that pound would be worth today 75p. And the song referencing the devastating impact of inflation on wealth over time, Mo Money, Mo Problems, in 1997. And Biggie was right, because that today would be worth 56 pence. So anyway, think about that. 23 years, that's a child being born to potentially leaving university. It's the bulk of retirement for most people. And even over that time, using a period of low historical inflation, the real terms value of cash was almost halved. So whatever your views, inflation is going to be a key feature of your life and your investments going forward, whether you like it or not. And as always, it's just about awareness, planning, and hopefully making better decisions. In Principles Personal Finance. Thanks very much for watching. And if you did happen to like it, if you could like and subscribe, that'd be greatly appreciated. Bye.